Most companies start with the wrong sentence. We need an investor. But an investor may be the wrong solution. You may need a buyer, a lender, working capital relief, a project finance structure, or simply better transaction analysis. If you choose the source of money before you define the problem, you can waste months solving the wrong thing. So before you ask who will fund us, ask a harder question. What financial decision are we actually trying to make? By the end of this video, you will have a simple diagnostic. Every situation begins in one of 6 places: acquisition finance, exit preparation, project finance, corporate finance or liquidity, capital raising, or transaction analysis. These categories can overlap, but one of them usually contains the first decision that cannot easily be reversed. Find that decision first. Then decide whether the next conversation belongs with a buyer, a lender, an equity investor, an advisor, or your own operating team. Here's the classifier. Ask 4 questions. First, what changes ownership? Second, what cash must move? And when? Third, which cash flow or balance sheet is expected to support the obligation? Fourth, what decision comes first? If ownership must change, you may be dealing with an acquisition or an exit. If a ring-fence project must support its own financing, you may be dealing with project finance. If the business is profitable but cash arrives too late, the problem may be liquidity. The label follows the decision. The decision should not follow the label. Start with acquisition finance and exit preparation. They both involve ownership, but from opposite sides. In an acquisition, the buyer must decide what is being bought, how much capital is required, and how risk will be allocated. A business costs $10 million, and the buyer can contribute $3 million of equity. The problem is not find an investor. The problem is how the remaining $7 million and the transaction risks should be structured. In an exit, the owner's first decision is different. What is being sold, to whom, and under what preparation and timing? Project finance begins somewhere else. The central question is not simply who owns the sponsor. It is whether a defined project, its assets, and its future cash flows can support a financing structure. The World Bank describes limited or non-recourse project finance as relying primarily on project cash flows and assets, while traditional corporate finance relies on the sponsor or parent company's broader balance sheet. A $30 million renewable project. The first work is to define the project economics, risks, timing, and financing perimeter, not to circulate a generic investor request. Corporate finance and liquidity problems can exist even when a company is profitable. Profit and cash timing are not the same question. IS 7 distinguishes operating, investing, and financing cash flows. Under the indirect method, movements in inventories, operating receivables, and payables affect operating cash flow. A distributor pays suppliers in 30 days, but collects from customers in 90. That 60-day timing gap does not automatically mean the company needs an equity investor. First, diagnose the cash conversion mismatch, the size and duration of the need, and the operating choices that influence it. Capital raising starts when the business has a defined use for capital and must decide which claims and obligations fit that use. At the simplest level, equity represents ownership, while a corporate bond is debt and does not create ownership. That distinction matters because the decision is not merely who has money, it is what the company is willing and able to give in return: ownership, repayment obligations, control rights, or some combination. Before approaching capital providers, define the amount, purpose, timing, risk, and acceptable trade-offs. Otherwise, the conversation begins before the mandate is clear. Transaction analysis is the 6th category, and it may come before any financing decision. Sometimes the real question is whether the proposed deal, project, or structure makes sense at all. Separate facts, assumptions, and interpretation. Identify what would change the decision. Test the consequences before choosing a funding path. This is where a vague opportunity becomes a decision model. If the underlying transaction has not been defined or tested, raising money faster does not solve the problem. It only finances uncertainty that has not yet been understood. There is an important objection. Real situations are rarely this neat. An acquisition may need debt and equity. A project sponsor may also have a corporate liquidity problem. An owner preparing an exit may need working capital before a buyer arrives. That is true. The framework is not saying that only one problem exists. It says one problem should lead. Identify the first irreversible decision Make it the primary category and treat the others as secondary work streams. This preserves complexity without allowing complexity to become confusion. Put the three illustrative cases side by side. In the 10 million acquisition, the first question is how to structure the remaining 7 million and allocate transaction risk after 3 million of buyer equity. In the 30 million renewable project, the first question is whether the defined project economics, assets, risks, and cash flows support a project finance approach. In the distributor, the first question is why cash leaves at day 30 and returns at day 90. These numbers are not forecasts or recommendations. They reveal three different problems: an ownership transaction, a project finance perimeter, and a working capital timing gap. Same word, capital. Different diagnosis. Before you contact anyone, run this checklist. What changes ownership? How much cash is required and when? What is the use of funds? Which cash flow, assets, or balance sheet would support the obligation? What is the first irreversible decision? Which facts are verified? Which numbers are only illustrative? And what could invalidate the current conclusion? Avoid three mistakes: using investor as a catch-all, treating profit as proof of liquidity, and selecting a structure before the transaction is defined. A clear diagnosis does not guarantee success. It gives the next conversation a valid purpose. So do not begin with, where can I find an investor? Begin with, what financial problem am I solving? Choose the leading decision. Document the evidence and assumptions. Then continue to the Najafi Capital playlist that matches the problem. This framework is educational and general. A real transaction requires jurisdiction-specific professional review.